Hello and good evening, everyone. We thank you all for taking out time on the working day today and be a part of this masterclass on tax planning. A warm welcome to all of you. So we at One Finance are reimagining the space of personal finance advisory in India, and we offer financial advice that takes into account not just your financial status and life goals, but also your traits and behaviors. We are backed and mentored by marquee investor Gauri Chadha Group. And in our constant endeavor to provide you with knowledge and resources on themes that will assist you in your financial well-being journey, we are here with masterclass event today. And today's masterclass on tax planning, which is quite a crucial component in financial planning. Considering the changes which were introduced in the budget, it is apparent that we not only plan for taxes and project investment declarations, but also to evaluate and understand which regime best suits you. And I'm sure the next 1 hour will be quite enriching and there will be a lot of takeaways for all of us. With this, give me a moment and we should get started. Let me share the presentation. The topics that we are going to cover today revolves around 5 to 6 themes. Tax planning for new financial year, understanding tax exemptions and deductions, which regime you should choose, old versus new regime, what are the ways that you can optimize tax on capital gains if you invest in securities, if you can invest in stocks, mutual funds like that. So what's the strategy for you today? Guide to claim TDS refunds and something for the first time IT return filers. So these are the topics that we are going to cover. Before introducing to my speakers for the day, I would like to tell you we will be taking question and answers at the end for 15 minutes. Whoever has any queries related to the topics that we are going to discuss or any other topic, our guests will be, for the day, will be happy to take it at the end, last 15 minutes. You can post your queries and questions on One Finance page and we will take it over at the end. Thank you so much once again. So, coming back to our speakers for the day, we have 2 speakers, industry stalwarts on, the topic. Mr. Arvind Rao, CA, CFM, CFP, founder of Arvind Rao Associates. He has 15 years of experience in financial management and tax planning. He's an active speaker and writer for various platforms across media and corporate houses. Welcome, Arvind. Thank you for joining.
Thank you so much, Manju, for having me here.
Sure.
And good evening to everyone.
Pleasure. The second speaker for the day is Gauri Chadha. She is CA, LLB, IIM-A Alumni and a tax and wealth management advisor. She has over 10 plus years of experience in tax and wealth management. She's a guest tax expert on various business news channels like CNBC Awaaz, Z Business and ET Now Swadesh. Welcome, Gauri, and good evening. And thank you so much for having.
Yeah. Thank you, One Finance, for having me. Thank you.
It's a pleasure to have you both here. So, before wasting much time, let's get started. Gauri, I would hand it over to you to take it forward for our attendees. Thank you so much.
First of all, I welcome all of you at One Finance. So we'll start with tax planning at the start of the new financial year, which is very important because once you start your tax planning at the new financial year, at the beginning of the new financial year, say April 1st week or maximum by 2nd week, you will realize eventually that you have saved a lot of money and you have taken the right decision while choosing your tax regime and so many other things. So we have listed few key reasons to start tax planning early. First is it creates peace of mind, because if you linger on and if you are doing your tax planning at the end of the financial year, you definitely end up doing wrong investments. You take wrong decisions, you choose your wrong regime. Maybe sometimes you invest in wrong options, and then later on you realize that it was not needed only. So you end up investing in venues which are not suited for you. Then it gives you disciplined saving, because once you start, like if you start in April, you can divide your investment over the period of 12 months, and then it can be convert it into maybe SIP or something kind of a SIP which can go to the ELSS fund or PPF or any other instrument on a monthly basis. So you don't have to put all your savings at the end of the year, and you can divide it by 12 and it won't pinch you. Then you get power of compounding, which I call it as eighth wonder, the power of compounding, because once you understand the power of compounding, you will realize how much money you can make by starting early, investing at an early age. So already, if you people have not started the investment journey, you just go online. There are so many calculators available. See and understand the power of compounding, and then you will realize how much importance it will give you for the investing point of view. Then you spread your tax liability. It's like your tax liability will be spread over the period of 12 months, and of course you will avoid random investments, because at the end of the year, like I mentioned, at the end of the year in the month of March, you end up investing in maybe ULIPs or maybe wrong LIC policies where you get cashbacks, money back and everything, which is not needed. These investments are they run on a very high commission basis. So it goes from your own.
We are losing you, Gauri. Hello.
You end up earning less than other investments which are better for you. Is it able now?
Yeah.
So like you can see, there's an example where we have assumed 1 year rate of interest or rate of return, you can say 10% in ELSS. Now if you keep that same amount in your savings account without investing in ELSS funds, you get 4%. So in short, you lose 6% of interest on a monthly basis, on an annual basis. So now if we compare NPS, we have assumed 9% rate of return, and again in savings and in few saving bank accounts, the rate of interest is lower than 4% also. It is somewhere in few banks it is 3.5%. So you lose around 5%. So and if you understand the power of compounding, you will understand that even 1% plays a very huge role. So 6 and 5% is really huge amount. It's massive. Can we come to the next slide?
Yeah, sure.
I can't move it. So for the employees who like we have entered the new financial year, so the employees should do few things. So there's a guide. We have prepared a 7-step guide to get started. So first is update, review and file your tax saving declarations with your employer on time. This will help you in deciding which regime you are going for, because that is of utmost importance. Otherwise you will end up investing in wrong instruments, and maybe sometimes you realize you don't need that investment and you have invested in that, and you can definitely do some changes with your CTC. Maybe you can shift your profile from employee to professional, and then you can save tax in that way. So you can sit with the employer and just discuss everything. Then of course after this you will declare your choice of old or new regime with the employer. And also if you want to decide on your own, there's a calculator available on income tax website, where you can enter your income, deductions and everything which you are planning to claim, and the calculator, it's very easy. The calculator will calculate your tax in both the regimes, and you will understand in which regime you are saving more tax. It's a very user friendly calculator available online, so anyone can use that. Then Of course, you can focus on tax saving in expenditures first, like tuition fees of children, LIC premium, and all of that sort of things. Then PF deduction is eligible for tax savings, so that you can consider, which is compulsory for almost all companies. So there's a very huge amount which goes in your PF deductions. Then you have to calculate taxes payable on income other than salary, because there are other sources also, like income from other sources, like interest and everything, your capital gains, your house property income, or maybe if you have some retainer or something also going on, maybe some business profession income, then that will also be included. So in your return you have to include everything. Then you have to pay your advance taxes on time if it is important, if it is required, because if you are on salaried basis, definitely your TDS will be cut as per the actual amount payable. But if you have any other income, like high interest income or capital gain or anything, that tax has to be calculated by you. The liability of calculating that tax and paying that advance tax on time is totally your liability. You cannot blame the employer for not doing it for you, because he will only do the salary part. The rest is totally on you. And if you don't pay your advance tax on time, then there's interest on that, which will be charged on monthly basis. So do remember, don't miss the advance tax due dates. Then of course, last is file your tax on time, tax returns, because last year we saw the time was not, the due date was not extended. This year also I am anticipating that they will not extend the due date. So it is very necessary that as soon as your documents are ready, everything is in place, go and file your return. Don't wait for 31st July. On the last day, even if the site is not working, I don't think income tax department will extend the due date. And moreover, if you file the return on the last day, you definitely will end up making so many mistakes. Either you will forget something, or you will enter wrong figures, or maybe, anything can happen on last day. So don't wait for the last day. And I will add one more point: while filing your income tax return, do check your 26AS and your AIS. That is the must. If you won't check that, trust me, you will get an income tax notice, because there are so many figures and so much information is available in AIS which you definitely will forget while filing your income tax return. And I'm sure Mr. Arvind will explain that further in the coming slides. So I will hand over to Arvind. Arvind, you can take it forward from here, and all the best.
Thank you so much, Gauri.
I hope you will enjoy the session with Arvind.
Absolutely, absolutely. Thank you so much, Gauri, for enriching and enlightening all the salaried individuals, especially where it's the start of the financial year, and there are a lot of things with the new considerations in the budget which employees have to take, and I'm sure the 7-step guide would really help them. Over to you, Arvind. Thank you so much, Gauri.
Thank you, Gauri, and thank you, Manju. And good evening to all of you who have logged in on a Thursday for a topic on tax, which generally, is considered very boring. And to that, when you say that you have to be sure of your tax planning at the start of the year, at least I think if I was not a tax guy, this doesn't sound very exciting to me, but here we are. And let me just also set the expectations right on the session while we begin. Since this is a very like an open generic session, so we have brainstormed with the team, and we have tried to keep it as specific as possible on certain issues. But for those of you who are already well conversant with tax, you might find that certain things are very basic and "Arey, ye to mujhe pata hai" types. So, but please remember, there are also other people for whom this might be a first-time knowledge. So, after that fantastic orientation on the start of the year by Gauri, I am delving deeper into the topic on exemptions and deductions. So, first, let's focus on what are the exemptions. Okay. So, basically, let me go one step back and help you understand that under the income tax, there are certain specific items which are exempt from tax, which means you don't have to pay tax on this money that you receive. And yes, you heard me right. There is some certain elements of income which are not taxable. Generally, people always have a feeling that you have to pay tax on everything, which is the case. But yes, there are certain exemptions, and we are going to highlight just like 6 of them today. So like for a salaried employee, the most common tax exemptions that are availed by individuals, one is a standard deduction. So friends, let me give you like a context here that people who are into business generally, that whatever they earn, they set off the expenses that they incur for earning that income, and they pay tax only on the net income or the net profit. This doesn't mean that an individual who is working as an employee is only earning income and there are no expenses. There are, I think, even if you remove the personal expenses, I'm not talking about shopping, etc., but traveling to work, maybe you are buying certain books for upgrade of your knowledge, maybe you are taking up some courses that is helping you to upgrade your knowledge and be up to date. So all these expenses are not permissible to be deducted from your salary. So just as a token compensation, there is a standard deduction allowed for an employee, which is at a flat rate of 50,000. So irrespective of whether your salary is 4 lakh or whether it is 4 crores, the standard deduction stays constant at 50,000. Moving to the second exemption, which is the house rent allowance or an HRA. So Income Tax Act recognizes that for an individual who is staying not in his or her own accommodation, but is staying in a rented accommodation and is paying rent, there should be some deduction that should be given to these individuals for paying rent. So here comes the concept of HRA, wherein if you are getting an allowance from your employer, there is a specified formula given for calculating how much of this allowance would be exempt. So once this formula takes into account mainly 3 things, that is the HRA that you get, what is your basic salary, and third is how much rent are you paying. So taking all these 3 into context, there is an amount determined which is allowed as an exemption or a deduction from your taxable income. On similar lines is, again, the Income Tax Act recognizes that everybody needs a holiday. And when you go on a holiday, it rewards you by saying that whatever amount that you spend on traveling to your holiday destination, you can claim it as an exemption from your taxable income, provided you are getting this allowance. So friends, please remember, other than the standard deduction, all the other exemption elements that you see on the screen can be claimed as a deduction or an exemption only if you are getting this allowance as a part of your salary. If there is no HRA or there is no leave travel allowance in your salary package, even if you go on a holiday and incur travel expenditure, you will not be eligible to claim a deduction or exemption. So leave travel allowance is something which is an element which basically tries to exempt the travel cost that an individual incurs for going on a holiday. Of course, as it always goes, there are certain conditions here, which are one, only those costs that are incurred for a holiday within India is covered. So if you go on a foreign vacation, sorry, LTA cannot be claimed. Second condition is only the travel cost is covered, which means if you're flying to your destination, only the flight cost to and fro will be eligible for exemption. The amount that you pay for the hotel or for eating or shopping there, all those things are not covered in this exemption. And third thing is it's not for the employee alone. The employee is allowed to travel, sorry, excuse me, I should not be using allowed. The employee can always travel with his family. But what is covered within the exemption is the employee himself, his or her spouse, and up to 2 children. So 4-member family travel cost to and fro can be claimed as an exemption under LTA. Then there is another element which is like a conveyance allowance. So basically, here actually I would want to separate this concept of conveyance into two parts, which is one wherein it said that there was a fixed allowance which was permitted to be claimed as an exemption, which was broadly to cover the cost that an employee incurs to travel from home to office and back. Friends, it's been around 3-4 years that this allowance has been abolished. And in place of that, you have this other conveyance, which is basically, it operates more like a reimbursement, which says that if you're traveling for official purposes and you're able to demonstrate or submit proofs saying that you have traveled from point A to point B for office purpose or official work purpose, then whatever reimbursement that you claim from your employer for these expenditures incurred, that is not liable to tax. And there is a reason why conveyance allowance, although it has been abolished, it has been kept here because I think it's been this exemption allowance has been around for I think close to 15 years, and along with that there was also a medical allowance. I mean, people who have been working for maybe more than a decade will remember that conveyance allowance and medical allowance used to be the most two common allowances that used to be claimed as an exemption. But let me give you an insight here that around 4 years back, both these deductions were abolished, and in place of that came standard deduction. So that's about conveyance. Fifth is education allowance. Now, it has been put here, but friends, practically this allowance is hardly of any use to an employee because basically this child education allowance is available for those people who have children, number one. Number two, the deduction is restricted to 100 rupees per month per child. If you are thinking that you heard me wrong, no, you heard it right. It's 100 rupees per month per child, and the Act has kept a limit of up to 2 children. So the deduction that you can claim under this is 200 rupees per month, which is 2,400 per annum. And the sixth element is the uniform allowance. So this is something which is applicable for those people who are required to wear a certain kind of uniform for their job. So I think the most common things that you can think of is like a pilot or an air hostess, and if they're incurring certain costs towards this uniform, whatever they incur, that can be claimed as a deduction. Moving from exemptions to the next set of deductions, there are 6 here that we are looking at. ATC. ATC. So now all these deductions basically are certain investments or certain expenditures that you may be incurring. These give you a deduction from your income. So the most common among them is ATC, which basically covers your PPF, life insurance premiums, the principal amount of the home loan repayments that you're doing. All these are covered under ATC. The limit prescribed under the Act is 1.5 lakh of rupees per annum. Second is the NPS. Here it is still a relatively new deduction as compared to ATC, and not many people are availing of it. But friends, it's very useful, and it's a long-term retirement scheme which one can look at. The exemption limit provided is 50,000 rupees per annum, and this is over and above the ATC limit of 1.5. So if you are able to invest up to 2 lakhs per annum, you can claim deduction under both these sections from your salary. Third is ATD, which is the health insurance premium. So this comes under the category of an expense that you are incurring for safeguarding your any unforeseen emergencies that come in relation to your health. And if you are having a Mediclaim policy, the premiums that you pay for them, those are eligible to be claimed as a deduction. Fourth is ATE, which is in case you are taking any loan for pursuing higher education for self, spouse, or your children, then any interest that you pay on this education loan, that also can be claimed as a deduction. And friends, the good news here is that ATE does not have any upper limit on the amount of interest that you can claim. So whatever is the actual interest that you are paying, that can be claimed. And this interest can be claimed for a period of 8 years from the time you start repaying the loan. So this is really one of the most rewarding deduction sections. Fifth is ATU. So, I mean, I don't want to sound saying that this is a very advantageous section, because this is basically a benefit conferred upon those people who have some kind of a disability. The Act recognizes that there are certain additional expenses that these category of people might be incurring to live their daily life, and hence under ATU they are allowed a deduction of up to 50,000 rupees. And if the person has a severe disability, the deduction limit rises up to 1 lakh. And the last, which is one of the most commonly used deduction, which is claiming interest that you pay on your home loan, or even the interest that you pay on loans that you take for doing any improvements in your houses. Section 24B is the section that is for this, and the limit prescribed is 2 lakh rupees per annum. So I think this broadly covers the deductions there. When we talk about exemptions and deductions, this whole discussion that has been going around the old versus new tax regime, and this has been in vogue for the last 2 years now. And this budget, when it got announced, we have all seen that there is a new tax regime. So before we go there, let's look at what are the main differences that what are the differences that exist between the old and the new tax regime. So first is that while we looked at a lot of deduction exemptions, so there are in all around 70 of those that have been provided for a salaried employee under the old tax regime, which is done away in the new tax regime. So I think the income tax department's message is quite clear that they are aware, or they have come across instances where people have probably been misusing certain exemptions or deduction sections, and they want to now move into a zone where there are no exemptions and deductions given, and people pay tax on their income. To some extent, they are helping this to be better by keeping the tax rates or the slabs on which you need to pay taxes. They are slightly lower under the new tax regime as compared to the old. So when I mean lower, as in the limits in the slabs have been raised, and the rates at which you pay tax on these income slabs have also been lowered under the new tax regime when you compare it with the old. And there are a lot of, if I can use the word, millennials who have now entered the workforce and are working. They don't believe that they need to save. So forget saving for tax saving. They somehow, many of them believe that they are not born to save, they are born to spend. So, it was really playing on their conscience that they need to do some saving if they need to save tax. And I think new tax regime is a win-win for them, because now they're laughing away at all those people who used to tell them or used to advise them that you need to at least do some savings a year so that you can save on your taxes, because now the new tax regime says that you don't need to do any saving, you just pay tax as per the slabs. So this is what the whole argument and discussion is around the old and new tax regime. And if we move to the next slide, Manju. Let's now talk about what are the things that have come in the new tax regime, which was introduced in Feb 23. So these are the 5 main highlights. One, there was in the previous new tax regime, the standard deduction of 50,000 that I explained to you 2 slides back was not available under the new regime, which is now being provided. So that's again the department trying to make the new tax regime more favorable for the salary taxpayer. Number two is most of us were aware that there is no tax if your income is up to 2.5 lakh rupees per annum. In the new tax regime now applicable from the 1st of April 23, this 2.5 has gone up to 3 lakh. Second is that they have enhanced the income slabs applicable, and this is something I will park for the time being because we have a slide which is showing you the difference between the rates of the old new tax regime and the new tax regime. So we'll come there. Fourth most important is that the new from April 23 the rebate available under the new regime has also gone up. And earlier the tax rebate was available for incomes up to 5 lakh rupees per annum. The budget has now enhanced the limit to up to 7 lakh rupees per annum. So again, this is a good reason to switch to the new tax regime for all those whose incomes are up to 7 lakh rupees per annum. And finally, while all the above 4 changes appealed to the lower to middle income levels, there was something also in store for the higher tax bracket people, wherein the surcharge was reduced from 37%. You heard me right. There is a surcharge for people who earn above 5 crores, which used to be 37%. This is over and above the tax of 30% that they pay. So this 37% has been brought down to 25%, which is quite substantial if you were to ask me. So yes, these are the 5 key changes, and as promised, this is how the comparative tax slabs look for an individual resident less than 60 years of age, basically non-senior citizens. Just another insight here for people who have been paying tax for like a good amount of years would remember that there used to be a set of slabs for males, and then there used to be a set of slabs for females, and then senior citizens. So it's been a couple of years now that females have no preferential treatment when it comes to income tax. Both men and female enjoy equality there. It's only that when you become a senior citizen that the slabs look different. So this is the way you see that up to 2.5 lakh was where the old regime, the new regime in the older avatar provided 0%. Now it has gone up to 3. And in every slab where it was a 2.5 lakh jump, they have increased it to keep a 3 lakh slab. So 2.5 to 5 becomes 3 to 6, 5 to 7.5 becomes 6 to 9, 9 to 12, and so on. So if you look at here carefully, that earlier under the new regime, we were paying 25% tax for an income up to 15 lakhs, which has now become 20% up to 15 lakhs. So 5% is has a quite material impact on the take-home pay when you look at it. So new regime in the new avatar applicable from April 23 definitely looks very interesting for people, especially people who have an income up to 15 lakh. Let's look at the next slide now. There has been some time spent, and of course, I think we are talking about this in end of April. And I remember when the budget came up in the first week of Feb, there was a lot of discussions and comparisons that happened how or who should choose between old and new. So in a nutshell, if you were to look at it, that for people, like I was mentioning earlier, that for people whose salaries are up to 15 lakh per annum, you have to make a choice between old and new, and you have to see at what level of deduction it makes sense to switch. But before we go, there is a slide that also will take you there. But before we go there, I just want to put one line that people whose salary is above 15 lakh, they just need to keep one simple thing in mind, that if you are claiming deductions which are which are up to 3.75 lakhs per annum, and this includes everything, your ATC, your NPS, Mediclaim, HRA, LTA, all these put together. If they are up to 3.75 lakhs, the old regime gives you better results. Otherwise, the new regime looks better. Manju, if you could just click on the tab. Friends, what you see on your screen is you can have a quick look at this. There are various income levels given, and there is also a guideline provided in terms of which regime looks better to you at which level. So like you check here, as you reach the 15.5 lakh, and unless you are claiming 3.75 lakh, the new regime looks better. And before that, the amount of deductions vary that you need to claim to see which looks better. Let's go back, Manju, to the next slide. Now, how to choose? So let's go to the old school method here now. I think again we are sticking to a 7-step guide here. One is you need to either bring up your sheet, or you need to sit with your tax projections that are provided to you by your employer, income projections, sorry. Check what are the taxes due on this income under the new regime. Then you do a parallel calculation of what are the taxes due on the same income if you take into account all the deductions that you propose to claim under the old regime. See which of the two, in which of the two options is the tax getting calculated the lowest. If the tax under new regime is lower, no brainer, go for the new regime. But if the tax regime, and this is something interesting, I would want you to pay more attention here. That is in case if you have not been paying attention till now, which is that if the taxes under the old regime is lower, still just don't blindly opt for the old regime. Check what is the tax saving that is coming in the old regime and compare it with the amount that you have proposed to invest to save that tax. In simple words, let's say the old regime throws you a result saying that the taxes under old regime is lower by 12,000 rupees per annum. And in order to save that 12,000 rupees, you have planned to invest, let's say, 1.5 lakh of rupees. So friends, it doesn't, in my view, and this, I restrict it to my opinion, that in order to save 12,000, if I have to invest 1.5 lakh, according to me, my cash flow analytics say that doesn't make sense. It is better to pay that 12,000 tax, because at least you have saved 1,38,000, which you can use for better purposes. And this is specially applicable for those people who are crunched for cash flow. So, I understand tax savings is important, but let's look at it more logically when you have to evaluate this. And that's why the 7th step says only if this difference is material, then you go for the old. Otherwise, new looks better. Let's move further. Here is a quick calculation to show you that a typical salaried employee who is getting 14.5 lakh and intends to claim HRA, get some meal vouchers, which is your Sodexo coupon, with the standard deduction, has some additional interest income, is claiming 1 lakh of ATC and 10,000 deduction towards interest. If you check here, the way the taxes get calculated, the new regime is lower by around 6,000. So again, I would suggest here that if it is really not important, and this is one example I was taking, like in order to, first of all, there is no saving for you in the old regime. Despite investing this 1 lakh in the ATC, you still end up paying more than 6,000 as compared to the new regime. So again, this is one of the cases where it's a no-brainer that you opt for the new regime. So this is the kind of calculation you need to do on paper in order to be confident of what you have to do next. Moving ahead, let's spend some time on, we have talked enough of salary, but obviously today is the age of diversification. people are earning income from other sources, like you invest or you trade in stock, you do trading or you do investments via mutual funds, real estate. So whenever you do these transactions, you are also earning some income from these asset classes. So what happens there is, so whenever you earn dividend from investments made in stocks, MFs, or any other, say, trust, these dividends are always taxable. You cannot do much about it. But in case you are incurring capital gains, then there are certain strategies or certain avenues that you can look to save tax on these capital gains, which is one, the most common is you can invest the capital gains in a house, in a residential house property. The reason I'm specifying and laying stress on the words residential house property is because many people generally ask this key, what if I buy a commercial shop? No friends, that is not allowed. You need to buy a residential property and you can get exemptions from capital gains if you have earned any capital gains on the sale of a residential house property. Similarly, if you are selling any other capital assets like shares, mutual funds, gold, art, or anything, any other capital asset that you can think of, and you are getting capital gains, then you have two options, which is either you again invest that money in a residential house property and claim deduction under 54F. Of course, there are certain conditions there. The prominent one being that if you are selling assets other than houses and buying a house to claim exemption, you should not be already having more than one property in your name, in which case the benefit is not available. But if it's your first house that you're buying, then of course you can claim that deduction. And for people who are not very happy investing in real estate, you have the option to invest in specific capital gain bonds, which is the 54 EC that you see on the screen. So these bonds, if you invest, the money stays there for the next 5 years. And you also get some interest, which is not very noteworthy, and it's hardly some 5.25%, which again, for your information, is taxable. But yeah, I think the draw or the advantage of investing in these bonds is you kind of save 20% tax that you would have otherwise paid on the capital gain. So certain other strategies that are generally done to maximize benefits under capital gains are like the moment you see certain gains, and let me restrict my conversation to, let's say you are actively trading in stocks or investing in stocks and you see that there are some capital gains and you are not in any mood to pay the capital gain tax, you could try and incur some losses, capital losses, so that these losses can be offset. Because one good thing about income tax and capital gains on shares is that you end up paying tax only on the net gain. It's not that if you are making a gain and a loss, you need to pay tax on the gain and forget about the loss. So you offset the loss against the gain, and whatever is the resulting gain, you need to pay tax only on those. So offsetting of losses is another strategy. And again, when you sell also becomes relevant, because the capital gain tax rate changes the moment the holding period changes. So I think many of you must have heard short term and long term. So short term for shares is when you're selling it before 12 months, and long term is if you're selling it after 12 months. If you sell long term, the capital gain tax rate is 10%. If you sell it short term, the capital gain tax rate is 15%. So depending upon the capital gain amount, the capital gain tax could be substantial. So that's why when you sell becomes relevant. And of course, there is also this tax deferral that is possible. So to the extent possible, we can try to take advantage of the deferral strategies as well. Let's move further. I think one of the last concepts in today's session is how do you claim this TDS refund? So friends, first and foremost, let me highlight that TDS is something that is deducted at source, and now I'm restricting my conversation to salaried employees. Generally, around the year when you're getting salary, your employer is deducting certain tax on it on a monthly basis, which is called TDS, number one. Number two, let's look at those situations or scenarios where why does a TDS refund come, or why does there arise a scene or a situation where whatever TDS your employer has deducted or some part of it, why will you claim it as a refund? And that is where the thing which Payal mentioned at the outset, which is making correct declarations of your expenditures and investments to your employer is very important here, because sometimes people are so busy and engaged in their day-to-day work that they don't give declaration. And in the absence of that, the employer will calculate taxes on the income as if there are no savings or investments that you're doing, which could result in a higher TDS being paid. But at the point of filing of returns, if you want to claim these deductions and exemptions, and there results from there a refund. So how do you claim this refund? This refund is only can be claimed only by filing your return. And one good thing, not only good, let me say one of the remarkable things that was seen in the last tax filing season was that the department has become super efficient when it comes to processing and issuing refunds. Like we have seen instances last year where refunds have come sometimes as quick as within 3 days of filing of return. And this is something unheard of, because there used to be times when we had to wait for close to 3 to 4 years to get a refund. So when people who got refunds in 3 days or 7 days last year, they were like shocked. So yes, it is possible. If you feel that your employer has deducted more tax and you want to claim that back, then yes, filing your return is an option to claim that. Filing your return early is a very good option, because the faster you file your return, the earlier the refund comes. And please note that many salaried people believe that मेरा तो सब tax employer ने काट लिया है, I have a form 16 and I don't have to file my return. That's a gross misconception. The moment your income is more than 2.5 lakh of rupees, even if there is TDS deducted on that income, you have an obligation to file the return of income. So that's how you claim the refund. Manju, let's move further. How do you claim this TDS refund? There is a nice graphic given here that you first check your form 26AS. How does a 26AS look like? Well, that's what you see on your screen right now. This is what is a 26AS called as. It's a form that uses data populated by the department from various sources, and it's issued by Traces, which is like a division of the income tax department for monitoring TDS. So this is available on your IT portal. When you log in using your login credentials, you can go and download. So 26AS becomes your first step to go back. When you get that, basis that, file your ITR. I think Manju, let's go to that segment where we show the various forms that are applicable. Let's just quickly go there. This is how a form 16 and the 12BB form, which is basically the form that gives details of the perquisites, looks like. Some of you must have seen this n number of times. For those who haven't, this is just for illustration. Going back is the next thing on which are the forms. Okay, we'll go there later. Once you file your ITR, check the refund status. And you don't need to like go there every day and check. I think once in a month is good enough. Check if there are any notices that are there against your claim. If yes, answer them, or push your consultant to answer them, whichever the case is. And in case you don't receive a refund for a long time, don't feel shy. You can always raise a grievance with the IT department and try to check what's wrong there. For people who are trying to file their return for the first time this year, here is a quick 6-step guide, which is get your required documents in your hands, register, create your login on the income tax portal. And the portal has improved a lot. It has a step-by-step guide of choosing which form is applicable to you. So go through that, fill the ITR form with your data, calculate the liability, and there are utilities available on the department's portal as well, which help you to calculate this liability. You pay the applicable taxes, and don't forget to e-verify or verify the ITR, because friends, till the time you don't verify the ITR, it is not processed by the department. So even if you have a refund and you have uploaded your return and you are now sitting and waiting that my refund will come, unless you verify the ITR, the department doesn't start processing the return. So if it doesn't process, your refund doesn't come in. A quick primer on who should file their returns in which form. So ITR 1, 2, and 3 are the typical forms applicable for individuals or those who operate HUFs as well. So very simply put, if you have only salary income and maybe one house property and only interest income, then go for the ITR 1. If you are very active in terms of capital gains and you have some mutual fund transactions or share transactions, then ITR 2 is what you need to do. And ITR 3 is basically if you have elements of income which is over and above what I mentioned, then ITR 3 is what you have to file. So this 6-step will help for all those people who are under the DIY segment. Otherwise, it's always easy to go to a consultant and get your return. So I think with that, we reach to an end of this, and Q&A is what I think must be, there may be few questions waiting for us. Manju, let's take that.
Absolutely. Thank you so much, Arvind, and busting certain myths and, giving us so much of knowledge, especially on, what were the key changes in the budget and which regime to, select. And obviously declarations play a quite important role, at the start of the financial year. Thank you so much for taking us, through the entire tax planning, masterclass. And I'm sure, the audience, who has stayed with us would really have a lot of takeaways, to take from. There are a couple of questions. Let me take. Absolutely. Let me just read out, a few questions. So one is on NPS. Rohit is asking a question. Is NPS a good enough given that there is no minimum guarantee of returns? What are the implications of tax on benefits on retirement corpus?
So let's break this question into two parts. One is there is no minimum guarantee, which is fair, because I think mostly any mutual fund or any share also doesn't guarantee. So since it's an equity linked product, it will never come with a minimum guarantee. So whether you should do that or not will depend upon your risk appetite and how much you are willing to take the risks on your investments. But coming to the second part, which is the tax efficiency of the NPS corpus on retirement. Rohit, believe me, if you were asking me this question around 5 years back, we used to tell people that NPS doesn't look that good today, because the entire amount with the entire corpus, you were required to go and buy an annuity, and the annuity was supposed to be taxable. But in the last 5 years, NPS has undergone a huge change, and today a person who retires at that point in time, they can pull out as much as close to 60% of their corpus tax-free, and only on the balance 40% is what they have to buy an annuity, which will lead to a taxable income as pension. But this 60% is huge, because that takes away a huge load from the taxable income. So today my word is that NPS looks extremely attractive as a long-term investment option, especially if you're looking for that additional 50,000 deduction that it provides.
Great. I'm sure, Rohit, you would have got your answer. Mohit again is asking on NPS. Mohit says he invests 50,000 annually in NPS in tier 1 account, and he has also asked his employer to invest 10% of his basic salary in NPS. His question is whether he will be eligible to claim deduction in both ways, or it will be restricted only to 50,000 a year.
Mohit, it is both. You get deductions both ways because both of them are covered under two different subsections of 80CCD. The one that we saw on the screen today was 80CCD 1B, which is for that 50,000. But there is also an 80CCD subsection 2, which says that if your employer is paying directly on your behalf up to 10% of basic, even that is permissible as a deduction.
Great. Thank you so much, Mohit. I hope you got the answer. Vatsal is asking, under which ITR is salaried personnel obligated to file, and does it make a difference if filing is done via ITR 1 in one financial year and under ITR 3 in the next year?
Good question. So it's not required that the form has to be the same every year. The choice of the form depends upon the elements of income. So if you have been filing ITR 1 for all your life, and let's say you end up selling your property in which you were staying, and you incur some capital gain, so that year your form changes, that's okay. So that year you file a different form, and the third year you go back to ITR 1, don't worry, the taxman won't come calling for you. That's okay.
Okay. Shubham is asking a question. How couples who are both working professionals and in the highest income tax slab make the best use of, or save tax? I mean, what are the strategies he's asking?
I think this presentation was just for them, so we kind of highlighted. But yeah, obviously you would want to know something more detail. I suggest you should consult somebody who can help you with a customized answer to that. Otherwise, these are the general pointers that you can keep in mind.
Right. Thanks. Also, Mr. Anil Kumar says, why don't they remove the education allowance and increase the tax and, charge an additional tax if income is more than 50 lakhs?
There is a surcharge today. For people above 50 lakhs, there is already a surcharge of 10%. But yeah, I mean, it's like what are you giving any deduction for children education? Answer is yes. Don't ask me how much amount, but there is a deduction. So it's like a ticking the box with 100 rupees per month per child.
Utsav is asking, is employer provident fund contribution and car lease payment exempted under new tax regime?
So employee provident fund comes, the claim comes under 80C, and since you cannot claim 80C under the new regime, that is not allowed. But car lease operates slightly differently, so that the benefit of a car lease will continue under the new regime also.
Right. Shubham again is saying, if his income is 12 lakhs plus, now if it is 7 and it will go up to 12 or 12 plus, which regime is better? I think the entire presentation you made it a point more than 6 lakhs and how to choose between. Maybe if you can refer that and answer this.
Correct.
So Vatsal is saying, is the gratuity that we receive taxable?
Up to 20 lakhs it is not.
Okay. Tax exemption under section 80 EEB is no more, or it's there in the current financial year. I think if he depends on the new regime or which regime he chooses.
80E, which is the education loan, right?
80EB, yeah.
80EB. I think this is no. So basically, under new regime, no deductions are allowed. Whichever section you want to name, you can confidently be sure that it's not allowed under new regime.
Correct. Vinay Prasad is asking, do NRIs who have income in India less than 2.5 lakhs need to file a tax return?
Not necessary. There is no obligation.
And Vinay is asking, is audit mandatory if taxable salary is more than 50 lakhs?
No, Vinay. So for salaried employee, there is no audit. It's only for business people. Thankfully, as on today, we never know what happens in the next project.
Absolutely. I'm sure we have covered all the questions. Still, if anybody wants to ask any questions, do DM us or write it on our comment section. We will be happy to take it. We have still a few minutes to take it forward. All right, I think, yeah, we are good to go ahead. Thank you so much, everyone, again for joining, and, Arvind taking us through all the queries and, giving us a lot of takeaways, especially at the start of the financial year. For all the attendees, I would really, say thank you so very much, for being a patient audience, patient attendees. And, we at One Finance, as I said, are reimagining the entire personal finance advisory in India. Do visit our website for more such, enriching tools and resources, magazines where, you can align your relationship with money and, achieve financial independence and well-being. Thank you so much once again for being there. Thank you so much, Arvind. Thanks a lot.
Most welcome. Thank you for having me here.